Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. In times of market uncertainty, investors often seek the safety of cash. This has been true over the past several years, as markets have swung due to the pandemic, geopolitical events, Fed rate hikes, inflation, gridlock in Washington, technology trends, and more. What role should cash play in investor portfolios today? Money market funds have experienced significant inflows. After over a decade of historically low interest rates, higher cash yields are a welcome development for many investors. Interest rates are higher across all cash instruments, including many savings accounts, certificates of deposit, and money market funds. Money market funds, for instance, have attracted inflows with total assets reaching new all-time highs of $6 trillion. This is more than double the assets held in money market funds prior to the pandemic, when interest rates were near zero for the better part of a decade. As the accompanying chart shows, money market fund assets have typically grown in times of economic distress, or when interest rates have been high. From a financial planning perspective, cash provides the liquidity needed to cover expenses and important life events. The down payment on an upcoming home purchase, for instance, should primarily be held in cash-like instruments. Similarly, it's important to have enough cash to serve as an emergency fund in case of unexpected personal events, such as injury or illness, or broader events, such as an economic downturn. Inflation erodes the value of cash. While cash is important, it can become problematic when investors hold too much cash. As the accompanying chart shows, the inflation-adjusted income on cash has consistently been negative when considering average certificate of deposit rates. A challenge with holding excess cash is the opportunity cost of not investing in stocks or bonds. Just as interest rates have risen for cash, yields have also jumped across many types of bonds. The average yield on U.S. investment-grade corporate bonds, for instance, is now 5.5%. Far more attractive than the average of 3.7% since 2009. Unlike cash, these yields are longer-term in nature, and these bonds could experience price appreciation if rates do decline. Similarly, the stock market has performed extremely well despite many investor concerns over the past few years. The S&P 500 is still up 8% with dividends, and has gained about 47% since the market bottom in 2022. Stocks and bonds have outpaced inflation over history. The prospects for cash will only worsen if the Fed does begin to cut rates later this year. The accompanying chart makes this opportunity cost clear. Due to inflation, what cost $1 in 1926 now costs $1.17. However, the stock market has significantly outpaced inflation over long periods of time. A hypothetical $1 investment in the stock market in 1926 would be worth over $13,000 today. A similar investment in long-term bonds would be worth $106, also outpacing inflation. Market fear and high short-term rates have driven significant flows into cash and cash-like instruments. While these may make sense for short periods, history shows that they are not the foundation of long-term financial success. The bottom line? Investors should review their cash holdings as the stock market continues to rally and the Fed prepares to cut rates. In the long run, holding a proper allocation of stocks and bonds is still the best way to achieve financial goals. Thank you for listening. For additional information, please visit MRAadvisory.com.